What's going on, everyone? Lalit here. Today, we'll be talking about 5 ways to make money in the stock market. I recently released my 7 streams of income video, and one of those streams is the stock market. And within the stock market, I make money in 5 different ways, and I want to share that today with you and how you can do it too. I'll keep the intro short. Like, share, subscribe. You know how it is. Let's get into it. Number 1 on the list, you got buying and selling stock. It's the most obvious one, super straightforward, but just to bring the point home, quick example. Let's look at Apple. If you bought a share of Apple at $115 and it's 121 and 5 pennies, then that profit would be $6.05, aka a 5.26% on your money. But a point I want to mention here is basically if you don't sell, you're not realizing your gains. So you could be 100% up, you could be 200% up, but if you don't sell or sell some portion, you're not able to take profits or trim your position to actually see any type of realization of any gains. And with respect to stocks, there's certain terminology when it comes to shares or kind of just lingo that's thrown around. So for example, when we talk about shares, you have shares like common shares, preferred shares, and other terms accordingly. And when we talk about the types of stocks, I'm sure you've heard of penny stocks, and then there's also blue chips, and there's a common acronym as FANG, F-A-A-N-G, Facebook, Amazon, Apple, Netflix, Google, etc. But with that, let's move on to the second way to make money in the stock market, dividends. A simplified way to explain dividends is essentially that, and let's use Apple as the example, if we buy one share of Apple, let's say at $120, regardless of the price, there's a certain percentage that the company issues to its shareholders in the form of dividends. So at the time of this recording, it's 0.68%, or roughly 20.5 cents per share of Apple that you hold. Dividends are a great way to earn income in retirement as well as non-retirement. It's super common though to just keep investing into your stock portfolio and then live off the dividends in the retirement phase, traditionally speaking. The percentage you get paid out in terms of dividend relative to the share price varies depending on the company, industry, sector, and other factors. So, for example, if you want income today, maybe a REIT, a real estate investment trust, where dividends are 8% plus per year in terms of what you would get back. So, for example, if you invest $1,000, then you'll get $80 and above, 8% or higher per year. On the other hand, if you look at Coca-Cola, or we look at the case example of Apple, Apple has that 0.68%, while Coca-Cola is closer to that 3.3 to 4% range depending on where the stock price is. The point here is, although Apple pays out less today, it grows in the long term in terms of it being a growth stock. While Coca-Cola, it does kind of this with its graph. It does grow in the long term, but not as much. But if you look at how many years it's been paying out its dividend, that brings us to a concept where you have dividend kings and dividend aristocrats. Dividend aristocrats are basically stocks that are in the S&P 500 that have been growing their dividend consistently. So they've been paying it out and it's consistent over 25 years or more. And then you have dividend kings, where they've been paying out a dividend and they've been growing it, not for just 25 years, but 50 years plus. A good example of this is MO, aka Altria, the same folks that own Marlboro. The strategy associated with dividend kings and dividend aristocrats is commonly referred to as dividend growth investing, which essentially is dealing with stocks that are growing their dividend, and through investing in this, your cash flow would be so much in the future just due to the compounding nature of that growth. Another strategy concerning dividends is dividend recapturing. Now, this is essentially trying to get that dividend as a payout by holding the stock for a very short term and basically seeing that real cash value hit your account, and then you would sell the stock accordingly. But you would sell it even before you receive the dividend, just on how the dates and everything work out, and I'll talk about this in future videos. But the point is, one really important thing to note here is that the dividend is actually a percentage of the share price. And so the theory is, if there's a $100 stock, for example, and it's a 1% payout in terms of dividend to the shareholder, then that would be $1 per year. And so if it pays 4 quarters, that's 25 cents each quarter. The thing is, whenever that dividend is paid out and you have a stock, it would be deducted from the share price. And so let's say that $100 stock doesn't go anywhere. It's 0% growth, 0% decline for the whole year. Then after a year, it should in theory be worth 99 cents because that dollar of 1% was distributed from the share price. That's the theory, but in practical, it's totally different with trading, so much heavy trading and ups and downs and demand and supply. It really doesn't reflect that in the chart. It may for a blip of a second, but good luck trying to find it because I haven't found it, and many others haven't found it. So it's just what it is. Third on the list, we got options. There are different types of options, and don't worry, this isn't just the YOLO bets or the Wall Street bets or making quick money and all that kind of stuff. But there's different types of ways to make money through options where you have ways to make huge gains. At the same time, you have ways to make guaranteed income. And so with this number 3, we'll be talking about just the trading part of options, whether that's swing trading, day trading, or you could also just hold it out for a long term. But the point here is you're trading on the pure contract price. So quick definition of what options are. Options, by definition traditionally, are basically a contract that's written up and you're agreeing with someone else whether to buy or sell certain shares at a certain price at a future date. Now, that's a lot of criteria, but it makes sense. It's kind of like almost like this. Let's say, coming back to Apple, let's say Apple's at $120 a share. If you think Apple by next year is going to go, let's say, to 200, and somebody thinks like, okay, maybe it could go to 150. So if you think that you could get it from 150 at a good price and someone's willing to sell it to you, but you think that it's going to go to 200, if they're going to give you their shares of Apple a year from now, for example, at $150 and you think it's going to be 200, then it's almost a no-brainer to take or to get into that contract with the other person for them to give you their shares, and then you would get them at 150, so you can immediately sell them at 200 if you think it's at 200, or whichever way it is. That being said, with options, basically it's a contract, and within that contract there's a price associated with that contract. That price we call as the premium. So within premiums and options, you're basically saying, hey man, to the person who's willing to give you the shares at 150 bucks, hey, I'll pay you, for an example, $5 a share today. $5 extra per share is basically going to the other person. Each option contract deals with 100 shares, and so within that 100 shares and you giving that $5 premium per share, you'd be giving the other person $500 for them to give those shares that he has at 150. And so 200 minus 150 is $50 profit per share, and you're spending $5. AKA, you are paying 10% in premium, but you are expecting a huge upside. Now, that is a definition, but in this number 3 on our list of how to make money in the stock market, when we deal with options, this method is talking about purely dealing with the contract price. And why this matters is because the contract price is a derivative of the stock price. And combine that with volatility, the contract price would change immensely the more volatile a stock is. For example, looking at Tesla, you can see that Tesla goes all over the place. It's super volatile. And with that, the contract prices are also super volatile. And so with these premiums going all over the place, there's a lot of opportunity to day trade, swing trade, etc., and make a lot of money. On the flip side, you have the Coca-Colas, AT&Ts, McDonald's, Home Depots of the world, which are far more safe per se and conservative, where you know they're solid companies, they're blue chips, they're going to grow, and you can kind of expect how fast they're going to grow from a stock price perspective, all else equal. And so with that, the option premiums, aka the prices of these contracts, are not going to be going all over the place. And so there is money to be made, but at the same time, if you want to make quicker money, you would go with more volatile stocks. And then depending on the scenario, you may not want to be just trading options just because purely on the contract price, if those prices don't even move in general. Finally, before moving on to number 4, the reason why option traders lose a lot of money is because of a simple fact that the option contract worth on the date of expiration is 0. And so getting into these short-term positions is awesome because these premiums go all over the place depending on the stock. But if you're calling it that it's going to go up and instead it goes down, you're losing money very, very fast, and vice versa. And the closer you get to that expiration date, there you go. It's going to be 0. So if you don't call it correctly or get it out of your position or kind of trade effectively, it's basically maybe not going to work out statistically speaking. Coming back, we got numbers 4 and 5, and it's still in the options realm, but this is how you can make guaranteed income. And it's through covered calls as well as cash covered puts. Covered calls are essentially you having a covered position, aka instead of buying a call purely in terms of buying a contract to attain 100 shares in the near future or in the future in general, here you already have the shares. And so you're actually selling a call, aka giving someone else the option to buy your shares at a future date, at a future price, etc. Cash covered puts, on the other hand, are essentially you saying, hey, I have the cash and I want to buy XYZ stock in the future at a certain price. The main difference is that a call deals with a stock whose price is above the market price, while where a put is below the market price. Folks that want to get into a put contract, aka they may be thinking, hey, there may be a downturn. Maybe this is 2020, so there could be a second wave of the Rona, for example. So they may want to buy puts in order to lock in a price in a future date at a certain price, so that let's say that some stock goes from $100 to $50. Let's say they buy a put to sell their stock at $75. And so where cash covered puts comes in is that you having the cash, you're cash covered, aka you have the cash to buy those shares at $75 if you think it makes sense. And since you're selling a put, aka giving the other person the option, you actually are getting that premium. And so with covered calls and cash covered puts, you're selling the options on the market, aka you either have the shares or you have the money to buy the shares, and so you're rewarded for taking on that risk. And so you keep the premium, and that's how you can get income consistently depending on when the expiration dates are of the contracts, whether that's week to week, month to month, year over year, etc. So there you have it. These are 5 ways I make money in the stock market and how you can do it too. Drop any questions in the comments below. You know how it is. Thank you so much for coming to the end. Like, share, subscribe, and I'll see you very soon. Cue the outro. Okay, yeah.